Hi friends, so I'll now move to the next chapter, which is on derivative analysis and valuation. Chapter 9. Just to give a broad overview of the chapter, what we are going to learn here is what are the different types of derivative instrument, who are the users of derivatives, broadly defining the difference between forwards, futures, or futures and options, and maybe in discussion on the advanced set of areas like your exotic option, credit default swaps, are your weather derivatives, electricity derivatives. Some of these points I've already discussed in detail in the practical portion itself. So some of this is already discussed in detail. Some of them may need little lengthier discussion. So let's start now with what is a derivative instrument and how does it derive its value. Now a derivative instrument is basically something which is going to derive its value from one or more underlying asset from one or more underlying asset. The underlying asset can be equity shares, can be forex, can be commodity, can be precious metals, can be interest rate, can be an index. So basically it is called a derivative instrument because it is deriving the value from an underlying asset. It is deriving the value from an underlying asset. The importance of underlying asset is without an underlying asset there cannot be any valuation of a derivative instrument, because a derivative instrument can have value only when there is a underlying asset. In the absence of an underlying asset, the derivative instrument will have no value. So whatever derivative instruments are having, they are dependent on an underlying to have value, and most of the time the changes in the value of a derivative instrument would broadly be equal to the changes in the value of an underlying asset. So as the underlying asset increases or decreases, we'll see a change in the value of the derivative instrument. On the maturity, what we normally do is we compare the derivative instrument on the maturity. The comparison is done based on our contracted price, and on that comparison we decide whether there is a profit or a loss which has been made. So on maturity we do that format: date, position, action, reference date and rate, and in that format we will do a comparison and check whether there is a profit which is getting made, a profit which is being made, or a loss which is being suffered, and that amount will be cleared off. That amount needs to be cleared off. Now in this chapter onwards, I'll also give some notes for you to write, because some of you have told me that give us notes also. So I'll start giving notes also, small summary notes for each of the question we are discussing, so that summary notes can help you. So just give me a minute. Theory summary notes. Let's write chapter 9, derivatives analysis and valuation. Derivatives analysis and valuation. This will take away a little bit of extra time to give the summary notes, but because suggestion has come, I'll work on that now. Derivatives analysis and valuation. Introduction. Introduction. Small kind of a summary note. Introduction. Derivative instrument. Derivative instrument derives its value. Derives its value from underlying asset. From underlying asset. underlying asset can be underlying asset can be equity, index, precious metals, commodities, forex. Underlying asset can be equity, index, precious metals, commodity, forex. Now, importance of underlying asset. Importance of underlying asset. In case at some stage you're not able to note down along with me, just pause the video and note it. I'll not be giving this Word document to you, so you will have to keep noting down. Importance of underlying asset, value of derivative, or change in value of derivative, change in value of derivative will be broadly equal to change in value of underlying asset. Broadly equal to change in value of underlying asset. No valuation of no valuation of derivative instrument without underlying asset. No valuation of derivative instrument without underlying asset. Without underlying asset. Without underlying asset. Profit slash loss is computed on the maturity date is computed on the maturity date by comparing with the contracted price. The price on the maturity date again depends on the underlying asset. Profit or loss is computed on the maturity date by comparing with the contracted price. And this point should do by comparing with the contracted price. Okay, I'll now move to the next one. Who are the main users of derivative? See, first let's understand the purpose of derivative instrument. Practically three purposes can be there. One is hedging, second is speculation, third is arbitrage. Hedging means I have an underlying transaction. Hedging means I have an underlying transaction. Example, exporter. An exporter is going to receive 1 lakh dollar after 3 months. He wants to hedge it. Speculation means you are making some guess estimate about the likely future prices, and based on that you want to do speculation. Speculation is what is practically done by a lot of people. Arbitrage is basically a situation where you are able to make riskless profits because there are certain inaccuracies in the market. Because of the inefficiency in the market, you want to make money. You want to make money. So that money can be made because of the inefficiencies which are prevailing in the market. There are certain price level inefficiencies which are there. Now, primarily the users are corporation, which is technically like the companies, to hedge the currency risk, forex risk, as well as inventory risk. What is inventory risk? Is you want to hedge. Uh, you are having 1 lakh kgs of copper, you want to hedge it, you can take copper derivative. Individual investor, speculation, hedging, yield enhancement is through arbitrage. Institutional customer, hedging, yield enhancement and arbitrage. Dealers are basically the forex dealers of the bank or other people, hedging, exploiting inefficiencies and earning dealer spread. So as such I said three purposes: hedging, speculation and arbitrage. Let's write main users of derivatives. Main users of derivatives. Primary purpose. Let's first write the purpose. Primary purpose: hedging, speculation and arbitrage. Hedging, speculation and arbitrage. This is the primary purpose: hedging, speculation, and arbitrage. Primary users: corporation, which is nothing but companies, corporation, individual investors, forex dealers, and maybe institutional investors. These are the primary users. Purposes: hedging, speculation, and arbitrage. And primary users are corporates, the individual investors, forex dealers, and the institutional investors. Okay, I'll move to the next one. What is the difference between cash market and derivatives market? Let's first understand what is cash market and derivatives market. In the ICI material, I think one point which is given, I don't agree to it, but otherwise the broadly they have explained the differences. Cash market, today you want to buy, let's assume 1 kg of copper. You will go to a shop, give them 500 rupees, get 1 kg of copper. That is a cash market. That is a cash market where tangible assets are traded. In derivatives market, tangible or intangible, like even an index, can be traded. So in cash market, I gave you an example of a retail shop, but in the context of financial instrument, cash market is if you are buying in BSC and NSC, the spot market. BSC, NSC in the spot market, where you can buy even one share. In futures market, we have a concept of minimum lot size. You cannot buy lesser than that lot size which is fixed. So there is a lot size which is fixed. You will have to buy that minimum lot size which has been fixed. You will have to buy that minimum lot size. Cash market is, this is what the point I don't agree. Cash market is more risky than futures and option, because in futures and option risk is limited to 20%, nothing like that. Cash market, you pay the 100 rupees. In futures market, for taking 100 rupee risk, we have to pay only 20 rupees. But the entire 20 can go bad. Also, people, if they have 100 rupees, they will invest 100 and take more risk. In fact, FNO is considered to be more riskier than the your cash market. Cash market is for consumption or investment. You have bought copper either for consuming it or investing. Here you can do hedging, arbitrage, or speculation. The purpose, as I was indicating earlier, hedging, arbitrage, or speculation. Derivative in contract value will change based on the underlying instrument. But what is the underlying instrument? The underlying instrument is in the cash market, but exact mapping may not happen. This is more of a procedural thing. Customer will have to open securities with a depository. Here you will have to open a futures trading account. In cash market, you will have to put all the money upfront. In futures, you do not put all the money upfront. With the purchase, you become a part owner of the company. Because you're a part owner, you're eligible to get dividend income. You can do voting. All that comes in. Let's write now. Cash market versus derivatives market. Cash market versus derivatives market. Cash market, this refers to a place, or cash market is where tangible assets are traded. Tangible assets are traded. Possible to buy one share, become part owner. Possible, I'm just writing the important points. Possible to buy one share, become part owner, become part owner, possible to buy one share, become part owner, become part owner, invest all money upfront, invest all money upfront, meant for consumption slash investment, derivatives market, meant for consumption slash investment, derivatives market, derivatives market, tangible slash intangible assets are traded, minimum lot size, you cannot buy one, maybe some 500 100 depending on the value of that share, minimum lot size, does not give ownership, does not give ownership, margin money, margin money, margin money, meant for arbitrage, hedging, and speculation. I think these are the important points. We can keep writing anything else also. I'm just giving the important summary notes. Meant for arbitrage, hedging, and speculation. Arbitrage, hedging, and speculation. Okay, I'll move to the next question. Distinguish between forward and futures contract. I think forward contract is something we saw extensively in the discussion of forex, and futures is extensively seen in the derivatives chapter. The manner of working of both are same. In fact, you want to know the profit or loss on the last day, date, position, action, reference date, and rate. Both profit and loss, because both help us in fixing a future price, and it's a contract to buy or sell a specified asset at a specified price on a specified date. So both are technically same. Then where are the differences coming? Forward contract is over the counter product. Future is traded in a competitive market. In forward contract, we will have default risk. What is default risk? Is other party is not fulfilling the obligation. Future contract, because there is an exchange which is sitting in between, the margin money is there, it ensures that default risk does not arise. Forward contract can be customized, future contract is standardized. Because of this, in future contract we do see those two issues. One is you will not be able to hedge the entire amount. So because our number of contracts comes in decimal, that challenge used to come in futures contract. And other challenge which is not relevant to the difference, the price on the last day may not match, that is the futures price and the spot price. So forward contract are traded on personal basis, competitive arena, customized, standardized, over the counter exchange is there. Most of the time forward contract will have physical settlement, future contract will not have physical settlement, it will have a net settlement, and there is a daily MTM which happens, daily mark to market, may be delivered on the dates, hardly takes place. Cost of forward contract is on the basis of bid ask spread, that is the banker will be making this money, bid and ask difference. Here you will have to pay some brokerage and exchange fees. MTM is not there, MTM is there. Margin is not required. Because of this, there is a credit risk. Margin is required, and because of which the credit risk part is not there. Broadly, the difference is very simple. Forward is an over the counter product. Future is not a over the counter. It is traded in the market. It is traded in the market. Forward versus futures. forward contract, over the counter, over the counter product, over the counter product, over the counter product, customized, no MTM, or let's write no marking to market, no marking to market, default risk, no margins. Margins are not needed, and there is a default risk which is there. A default risk which is their OTC product customized to the requirement, no MTM. Default risk is there because there's no concept of margin. There's no concept of margin, and mostly physical settlement will happen. All these points we have already seen when we were doing the problem solving also. Futures contract, futures contract, exchange traded product. It is standardized. Exchange traded product. There's a standardization which happens. Daily marking to market. No default risk. No default risk. Margins are needed, and mostly net settlement or cash settlement. Cash settlement slash net settlement, whatever name you want to give. Cash settlement slash net settlement will happen. The broad difference between forward versus futures. Broad difference between the forward versus the futures part. What is marking to market? See, in a derivative instrument, what happens is the value of the underlying asset changes on a daily basis, because of which the value of the derivative also changes on a daily basis. So when we were solving derivatives question, we saw a concept of maintenance margin and initial margin. So this marking to market is basically an extension of that concept. In maintenance margin and your initial margin, we were calculating how much should we replenish the margin account, or how much should we withdraw from the margin account. So in a marking to market, at the end of every day, you will calculate the profit or loss, and this profit or loss is debited or credited to the margin account, so that adequate money is available on in the margin account. Because the profit or loss, if there's a profit, the exchange has to pay or the broker has to pay, but if there is a profit, if there is a loss, they have to recover, and that money should be there in the margin account. Recording the transaction at a value which reflects the market value of security. Futures contract are marked to market on a daily basis. All outstanding contracts are repriced. So they say futures basically provide a better risk management measure, because in forward contract we don't do this, and because of this only, there is a risk of that default risk which we are seeing. Default risk exists in case of a future forward contract. In futures we do not have that default risk. Marking to market, marking to market, process of recording, process of recording the futures contract or the derivative contract at the closing price, at the closing price on daily basis, on daily basis. Profit slash loss, profit slash loss profit slash loss is transferred to the margin account. Profit slash loss is transferred to the margin account. To the margin account. Transferred to the margin account. MTM provision ensures futures have futures have a better risk management measure as compared to forward contract. See, we don't know how the ICI is going to test the theory segment. That is why I've been covering in detail. In case these videos, because now I've started dictating, you find it slow, you play the videos at 1.5x or whatever speed is comfortable for you. But the videos, the theory video can become lengthy moment I start giving the summary notes. But because of the students' feedback, I've started doing it. Okay, let's move to the next one. Okay, let's move to the next question. What are the advantages of stock index futures over stock futures? See, futures is basically a contract on an underlying asset. The underlying asset can be a stock index like Nifty or Sensex. Nifty consists of 50 shares, Sensex consists of 30 shares. Or it can be an underlying stock like TCS futures or ICICI Bank futures. So when you have stock index vis-a-vis a stock future, index because it consists of so many shares, the manipulation will be on the lower side. It can help us in hedging a overall portfolio. We used to check this in our problem solving, that using an index futures which has a beta of 1 time, we were able to increase the beta or reduce the beta. Flexibility to one's investment portfolio. Large investors want to use index futures for hedging purpose. Also, you can make speculative gains. What is, though it is less, it changes less, but the margin requirement, that is how much money you want to put initially, is on the lower side. So people can make a lot of speculative gains using leverage means giving a smaller amount and taking a position on a huge exposure. If cost efficient hedging cannot be manipulated, consist of many securities, because of which the capital requirement or margin requirement is on the lesser side. One can sell contracts readily because there is a lot of buying and selling which is happening, so it's easy to do this. In case of individual stock are settled against physical delivery, stock index is settled in cash all over the world. But in India's context, even your stock futures are also settled in cash only. Regulatory complexity is less. Hedging or insurance protection. Main purposes for hedging. Sometimes speculation can also be done because it is less manipulative. It needs lesser capital and provides a better risk measurement or risk management instrument. Next, advantages of stock index or stock index future. Sorry, stock index futures versus stock futures. I think this and the next question is kind of interrelated. Stock index futures versus stock futures. Stock index futures are subject to less manipulation, cost efficient hedging instrument, cost efficient hedging instrument preferred by institutional investor slash preferred by institutional investors slash institutional investors corporations for hedging purpose speculative gains through leverage. You can make speculative gains using leverage. Speculative gains through leverage. Gains through leverage. Speculative gains through leverage. Less capital requirement. Less capital slash margin requirement. I think kind of does this. And the next thing is advantages of stock index futures. I think I've already talked about them, whatever we wrote there. Investors use stock to change the weights or risk exposure of their investment portfolio. That is, you can increase the weight or reduce the weight using the index futures. That is what we used to do in that security beta weight product format. Allow investors to separate market timing from market selection decision. See, point is, I know that markets are likely to go up. I want to invest, but I don't know which stock to invest. Let's not worry about it. Go ahead and invest in the index. Investors want to take advantage of perceived immediate increase in equity, not certain which company to buy. Please buy the index. Please buy the index. Through index arbitrage, hedge the portfolio, speculative gains, maintenance during stock market correction. So basic thing is whatever you saw as the differences, those are technically the advantages of stock index futures. Next, distinguish between options and futures. The primary difference is very simple. Futures gives you a right as well as an obligation. It gives you a right as well as an obligation to buy or sell. Option does give you a right but not an obligation. You get a right to buy in case of a call option, and you get a right to sell in case of a put option. So that's the benefit as far as your options are concerned. In order to do this, you will have to obviously pay an initial margin money. So in option, buyer has the right but not the obligation. In futures, you have a right as well as an obligation. Option traders use a mathematical factor, the delta that measures the relationship between the option premium and the price of the underlying asset. Most of the time, the option value will change with the underlying asset, but many a times it can even independently change because days are passing. Futures contract will change more with the underlying asset. In option, you will have to pay a premium, that is your initial cost, which is like a sunk cost. In case of futures, you will have to maintain some margin, initial margin, and this margin will keep going up or down based on the MTM profit or losses. Option versus futures. Option, right to buy slash sell but not an obligation. Right to buy or sell but not an obligation. Right to buy or sell but not an obligation. You get a right to buy, but there's no obligation which comes in case of an option contract. Premium is the initial cost. Option price can change independent of, you will see this in the next question, independent of underlying asset. Independent of underlying assets change. Futures, right as well as an obligation. right as well as an obligation, maintenance margin and initial margin to be deposited, maintenance slash initial margin to be deposited, futures price, futures price will change based on underlying asset, will change based on underlying asset. Next, what are the factors affecting value of an option? One is underlying, but apart from that, time to expiry. If every one, see, normally the premium for a Jan month contract will be lower, Feb will be higher, March will be highest. So today we are in January, Jan ending contract will be lower, Feb entering contract will be higher, March will be highest. So one is movement of the underlying asset, where call will move in line with price moving up. When the stock price goes up, call again will increase. Call as a positive delta, put as a negative delta. Time till expiry. So as time passes by, you will see the value of the option coming down. Ultimately, time can determine whether your option trading decisions are profitable. Volatility in stock prices are technically called a standard deviation. Higher the volatility, more will be the value of the option, how volatile the stock has been. Interest rate, as interest rate goes up, the present value of the future exercise price goes down, and this will also impact the option price. So factors affecting the value of option: price of underlying asset, price of underlying asset, call has positive delta and put has negative delta. Price of underlying asset, call as positive delta, put as negative delta. Time to expiry, longer expiry, longer expiry will have higher premium. Volatility, volatility, higher volatility will lead to higher premium. Volatility is on the higher side, premium will also increase. Interest rate, interest rates. Now this we have already seen: delta, gamma, theta, rho and vega, so I am not going to talk about them. We have already seen option Greeks as problem solving. Exotic option also we have seen as problem solving, so not discussing these two. What are the two types of risks which are impacting financial products? What is a financial product is? It could be anything. It could be an example, bond of ICICI Bank, or it could be a derivative instrument. It could be copper futures. It could be anything. There are two types of risks which are there. One is market risk and second is credit risk. What is market risk is the prices keep changing due to adverse movement of the stock market, interest rate, foreign exchange. To cover yourself against this, ICICI prices going up or going down, I want to protect, I can go through financial derivative, that is futures, options. I can take them and cover and recover or cover myself against the increase or decrease in the prices of ICICI Bank. Credit risk is called as default risk, for which we have credit derivatives. We have learnt about credit derivatives. I'll discuss broadly again now. But credit derivatives, we saw two types of credit derivatives. One was CDS, credit default swap, and second we saw was collateralized debt obligation, CDO. These are the two instruments which were part of your syllabus to cover the credit risk. Next, risks impacting financial products. Risks impacting financial products, market risk, variation in price, variation in price due to change in market, due to change in market, covered through covered through financial derivatives, covered through financial derivatives. I'll take the financial derivatives and try to cover these things. Credit risk, default risk slash counterparty risk, default risk or counterparty risk, covered through covered through credit derivatives, covered through credit derivatives. We're just making very small summary notes. I think 12 questions are covered till now. In that few questions, I did not give notes because we have seen that in the earlier problem solving area. But around one page only it has come till now. Next, working of a CDS. CDS, I think we have already seen in the theory part. In case I need certain notes, I'll explain it. But what CDS is? CDS is basically like an insurance providing protection to a protection buyer by a protection seller. A protection buyer gets a protection from a protection seller against the default of a reference entity. Insurance against the risk of a default. Under this arrangement, one party called buyer needing protection against the default pays a periodic premium to another party who in turn assumes the default risk. In case default takes place, there will be settlement. No default, no cash flow will happen. Although it resembles the option, but since element of choice is not there, you do not have a choice. It resembles more of a swap arrangement. Premium depends on how risky is that underlying reference entity. If more credit risk is there, premium will be on the higher side. It is a non-standardized. What is non-standardized? It is a customized product between the buyer and the seller. So you can say this more of a forward contract rather than futures contract, not traded on any regulation. You have an international swap and derivative association, ISAT, which gives out the regulations for this. You can buy it from third party to protect itself from the default of borrowers. And individual investors who's buying bonds, if he want protection, he can also do this. The cost or the premium has a positive relationship with the risk attached with the loan. If risk is on the higher side, premium will be higher. If risk is on the lower side, premium will be lower. If you are buying a CDS without having underlying asset, you are doing a naked CDS are basically speculation, because I feel that that company is going to default. I feel that the company is going to default, so I enter into this arrangement. CDS. We have already seen this in detail in problem solving area, so I am not explaining in detail now. Credit default swap. CDS is an instrument. CDS is an instrument to buy protection. Is an instrument to buy protection against default risk. Against default risk. Protection buyer pays protection buyer pays a periodic premium to protection seller. Protection buyer pays a periodic premium to protection seller. Premium depends on credit risk of reference entity. Credit risk of reference entity. OTC product, customized, OTC product, customized, covered under forward contracts. Now the part is we are taking protection against the default risk, but in US, because a lot of people kept on doing the CDS transaction, some of the bigger companies who kept on giving becoming a protection seller because of lot of defaults, they were also not able to fulfill the commitment. The company which gave protection, because it's a forward contract, the person who gave the protection against the default, these guys also defaulted. So that is why in forward contract we always have this risk, default risk. Naked CDS, used for speculation, buying a CDS without underlying purchase of bonds, without even buying the bonds, you are going ahead and buying a CDS. Doesn't really make sense, but you still wanted to buy the CDS, so you go ahead and buy the CDS in the market. What are the prime applications of CDS? Again, the applications can be only three: hedging, arbitrage, speculation. Hedging is if you have an underlying asset. Arbitrage is if you see that the premium which is there is not sufficient, or the premium is on the higher side or on the lower side. Buying a CDS and entering into a asset swap. A fixed coupon payment is swapped against a floating interest stream. Arbitrage will lead to profit if the cost of CDS is lower than the net benefit. So what I am going to do is I'll be making a fixed payment, receiving a floating payment, or making a floating payment and receiving a fixed payment. In this there could be a credit risk. That credit risk is neutralized through the CDS, and the benefit from the swap, if more than the premium, I get make gain. Speculation is entering into a naked CDS. Who can do? Initial borrowers. It's also called as a reference entity, which are owing a loan or a bond obligation. So the parties to the CDS, initial borrowers, there's a protection buyer and there's a protection seller. The settlement process of CDS was also explained to you. The settlement process can be through either a physical settlement where I will give the bonds and get the entire amount, or I'll be getting the net settlement, which is a cash settlement, where the difference between the par value and the market price of the debt is being paid. I think both of these were discussed in the theoretical, in the discussion on problems. Still, I'll quickly write some points here. Application of CDS, arbitrage, hedging, speculation. Parties to CDS. You can write a line explanation in the side if you want. Arbitrage, hedging and speculation. Initial borrower slash reference entity. Protection buyer, protection seller. These are the parties to a CDS arrangement. There's a protection buyer and there's a protection seller. Application of CDS and parties to CDS. Then settlement process. CDS settlement. CDS settlement will happen. CDS settlement will happen only in case of default. Only in case of default. If a default does not arise, there is no question of a settlement. CDS settlement will happen only in case of default. So if a default happens, CDS settlement is going to happen. If a default does not happen, no concept of a CDS settlement. Physical settlement. protection buyer will give defaulted bonds to protection seller, because these are of mostly worthless. I'll give them and receive face value of the bonds. Market value will be very less. I'll receive the face value. 100 rupees is the face value. Market value is now only 20 rupees. So I'll give the bonds, get 100 rupees from him. Cash settlement. Protection buyer will receive the difference between face value and market price. Difference between face value and market price. Difference between face value and market price. Okay, let's proceed. So we're done with the settlement process of CDS. CDO is something I've already explained in the theory segment. I'm not going to discuss them again. CDOs pool together various debt instrument. It can be bonds, loans. It is similar to your securitization part. We have three types of CDOs. One was a cash flow CDO, collateralized synthetic CDO, and an arbitrage CDO was there. Various risks involved in CDOs. Okay, we can discuss on this. I think let's write directly. Various risks involved in CDO. Most of these risks are related to interest rate swap chapter. There we saw those risks which are there. Anything related to a debt instrument. So first is default risk. Default risk, that is if the counterparty is delaying the payments, you can cover it through the CDO. The CDO can cover it through maybe a CDS kind of an instrument. Interest rate risk, that is we are having fixed interest income and paying floating interest income, or receiving floating interest income and paying fixed interest income. This is also known as basis risk. That's what I remember. Also known as basis risk. Liquidity risk, not able to make the payment. Prepayment risk, if people are making prepayments, that is also a problem. Reinvestment risk, I'm not able to find adequate reinvestment options. And forex risk, there's nothing much for me to explain because we've already seen this in the interest rate swap. Default risk is the counterparty is delaying the payment. Basis risk is my income is fixed interest, expenses floating interest, or my income is floating interest, expenses. Liquidity risk is I do not have money to repay the liabilities. Prepayments is my customers are making prepayment, I don't know what to do with the money. Reinvestment is whatever inflows I'm getting, I'm not able to reinvest at an adequate rate. And forex risk comes in case you have a foreign currency asset or a liability. Sometimes CDO comprises of debts from countries other than the country of issue. Next, distinguish between financial option and a real option. Real option was coming in that capital budgeting part. We did real option valuation, where you can have an option to expand, option to abandon. When we were doing the valuation, I said real option is similar to a call option or a put option, but still the method of working is slightly different. Financial option is an underlying asset that is normally traded in the market. Real option has an underlying asset which is project. So financial option, most of the times, whatever payoff you are going to get, it is specified in the contract. Here you derive it from the value. Financial option is a exchange traded product. Real option is an over the counter product. This will have mostly 1 year kind of a life. Here the projects go on for a longer period, and what they say is financial options are priced in the market. Real option is valued. Approaches, these are normally traded, they are priced. These options are used to take decision, they are valued. You will have to value these options. Financial option versus real option. Financial option versus real option. financial option, financial option, traded in the market, traded in the market, shorter period, shorter period, maximum of 1 year, traded in the market, shorter period, maximum of 1 year, there's a shorter period, payoff is specified in the contract, payoff is specified in the contract, these are priced by the market. Real option, underlying contract of a real project, underlying contract of a real project, longer period, longer period, real project, payoff varies based on cash flows, based on cash flows, real options will have to be valued. There's no pricing of this in the market, you'll have to value them, will have to be valued. It can be an option to expand, you can write real option, real option can be an option to expand, abandon, mostly expand or abandon is what you will get. Expand or abandon the project. Okay, what are the key criteria that a commodity must meet in order to be considered suitable for commodity derivatives trading? Now we are now moving from our normal derivative instrument to commodity derivative. I think the last few segment will talk about commodity derivatives, weather derivatives, electricity derivatives. These are the derivatives we are going to talk about. Commodity derivatives, see, you cannot do derivatives on everything. There are certain conditions to be met. For example, futures are not there for every company, futures are there for some specific companies only, and the conditions are very simple. Most important condition is there should be an active market, active market, that is a lot of buying and selling should happen for that commodity, lot of buying, liquidity should be there, volatility should be there. If price is not volatile, nobody is going to enter into a derivative contract. So volatility and liquidity is very very critical. Standardization, standardization means you should be able to have standardized quality and quantity, specifications regarding the composition, grade, all should be very clear, should be easily exchanged and traded. Deliverability means you can deliver them. Liquidity is very very crucial, active traded. Price volatility, price volatility, certain level of price volatility, market demand, there should be a demand for the commodity for consumption purpose or for investment purpose. If it's not there, nobody is going to enter into commodity derivatives trading. So key characteristics, key characteristics of a commodity, of a commodity for qualifying, for qualifying as commodity derivatives, for qualifying as commodity derivatives, qualifying as commodity derivatives. Standardization, quality and quantity, deliverability, active market, liquidity and active market is same. Liquidity, price volatility, price volatility. There should be a volatile price. Prices should be volatile. Market demand for investment or consumption. It could be for investment purpose or for consumption purpose. What are the needs of the users of commodity derivatives? See, point is why example or why is commodity derivative coming into picture, because somewhere the hedger wants price risk reduction. Example, copper futures. I want to buy copper futures so that I want to eliminate the risk of copper prices changing. Instrumental needs are the hedgers needs for price risk reduction. Hedgers wish to reduce or eliminate the risk at low cost. This is the core service of the commodity derivative. Apart from price risk, they also want some flexibility in doing their business, easy access to market, efficient clearing system. All these are convenience needs. It should be easy and convenient to enter into a derivative instrument, a derivative contract. They deal with the customers need to be able to use the core service with relative ease. The service offering is not restricted but has to be complemented by the so-called peripheral services, or technically the convenience needs. So we have two needs: needs of needs of users of commodity derivatives, needs of users of commodity derivatives. Core need core need, price risk reduction. This is the core need or the instrumental need. Convenience need convenience need, ability to enter into. Convenience need, ability to enter into derivatives contract with ease. with ease Enter into derivatives contract with ease. What are these? Efficient clearing system, efficient clearing system, easy access to market, flexibility in doing business. All these are convenience needs. So first meet the core need, and then do the convenience need part. Convenience is very, very critical. What are the advantages of commodity market? Explain the benefits of commodity future. See, as a customer, I want to buy the core assets. What are the core assets? The real assets I want to buy. What is real asset? A copper or a gold or something like that I want to buy. But I don't want to go to the market and buy, because when I go to the market and buy, there are a lot of one, the prices are not standardized. Sometimes I end up paying extra. The quality could be a challenge. So most money managers prefer derivatives to the tangible commodity. I don't want to buy the tangible commodity. Let me buy a derivative. Less hassles. Allow indirect investment in real assets. I'm able to indirectly invest in the real assets that provide an additional hedge against the inflation. Advantages of commodity futures: easiest and cheapest way to invest in commodity. In the market, there are agricultural commodity like soft commodities, fibers, grains, food, energy, and metals. So these are the things. So if you want to buy gold, please buy gold futures rather than buying the physical gold. You want to buy crude oil, buy the energy futures rather than buying the real crude oil, because this gives you more flexibility and there are less hassles in this. Advantages of commodity market: easy to buy, easy to buy as compared to tangible commodities, easy to buy as compared to tangible commodities, less hassles, less hassles. Tangible commodity buying, you will have to store and all, quality issues can be there. Indirect investment in real assets, which give protection against inflation, which gives protection against inflation. Then benefit of commodity futures, benefit of commodity futures, cheapest and easiest way of buying commodities, easiest and cheapest way of buying commodities. We have three types of commodities: agricultural products, plus agricultural products, energy products, plus I think metals. Yeah, metals. The cheapest and the easiest way of buying the commodities is through the commodity futures. That makes it easier for you to buy. Okay, let's move to the next question. Discuss the types of commodity swap. Now, in interest rate swap, we have seen this. One is called fixed versus floating swap, which we have seen in an interest rate swap. Similar thing can be there in a commodity swap, where you have different indices in the commodity market. I think your material talks about 2 3 indexes. Example, S&P Goldman Sachs Commodity Index or Commodity Research Board Index. These indices have different weights of various commodity. So there will be a price attached to these instruments, and based on that you can do the exchange. So fixed versus floating swap can be there, or commodity for interest swap. Commodity for interest swap is take any commodity. An example, take an commodity of copper. So first month, whatever is the increase in copper or decrease in copper price, that I will exchange with an interest, which could be the base rate plus or minus certain changes. Similar to an equity swap, in which total return of a commodity is exchanged for some money market rate plus or minus a spread, plus or minus a spread. Now, right, types of commodity swaps. Types of commodity swaps: fixed, floating swap, fixed floating swap, similar to interest rate swaps, with the exception, similar to interest rate swap, with the exception that both indices are commodity based indices. Commodity based indices. Some Goldman Sachs index is there, or the other one, Commodities Research Board index is there. Commodity for interest swaps: exchange of return of a commodity, exchange of return of a commodity with exchange of a return of commodity with an interest benchmark plus or minus a spread, with an interest benchmark plus or minus a spread. What are the peculiar characteristics of a commodity swaps which have a bearing on their valuation? See, initially when I gave here, I said All these are very critical: standardization, deliverability, active market, liquidity, price volatility, market demand. But still, in commodity you will not see so many people. Stock markets, there are a lot of buyers and sellers, but commodity you will have limited buyer. Unique nature of the commodity markets refers to the limited number of participants in this market, because of which liquidity can be a question mark. Unique factors which drive this markets, and the interrelationship. There is a relationship of an agricultural commodity with an energy market. Our energy market will have because agricultural commodity, the cost of that can depend on what are the energy prices and the individual participants in this market. So the peculiar issues here are limited number of participants, unique factors which are driving these markets, and there is an interrelationship with the other markets. So cost of hedging, institutional structure of the particular commodity, liquidity, seasonality, variability, brokerage fees, credit risk, all these are going to impact the valuation of a commodity swap. Factors impacting valuation of commodity swaps. Factors impacting valuation of commodity swaps: cost of hedging, liquidity, cost of hedging, liquidity, brokerage fees, credit risk. These are unique factors. These are unique factors. Credit risk, seasonality, limited number of buyers, unique factors, interrelationship with other markets. Interrelationship with other markets will have a significant bearing on the valuation. Significant bearing on the valuation. Limited number of buyers, these are the unique factors which are there, and there are a lot of interrelationship which is there. Write short note on embedded derivative. What is embedded derivative is, let's assume I enter into a contract, very simple contract. I am going to buy 100 books from a publisher, or let's not take the example of a book. Let's assume I'm going to buy 10 gram of gold on a daily basis from a shopkeeper. It's a very simple contract. Or I'm going to sell 10 grams of gold on a daily basis. Or okay, sorry, let me take an example. Sale of 100 grams of gold at the end of every month. Now the price is not fixed, and I say the price will prevail, or the price depends on what is the current market price or some formula I'm adding. So if you're adding some formula for the price, that formula is a derivative contract, because in derivative you'll have to do daily mark to market. So people, in order to eliminate from this marking to market risk, they may want to enter into a host contract and add a derivative contract in that. An embedded derivative is a derivative contract that is embedded in another contract, the host contract. The host contract can be a debt, lease, insurance, or a sale or a purchase. A beautiful example: a coal purchase contract may include a clause that links the price of a coal to a pricing formula based on the prevailing electricity price or related index. Coal purchase is a host contract, pricing formula is an embedded derivative, and for this embedded derivative you will have to do mark to market other than the qualifying hedging instrument. This requirement on embedded derivative is designed to ensure that mark to market cannot be avoided. You cannot be avoid this by including a derivative in another contract. An embedded derivative modifies the instrument's inherent risk and would be considered closely related. An embedded derivative that changes the nature of the risk is not closely related. So there are two types of embedded derivatives. One is closely related embedded derivative, and another one is not a closely related embedded derivative. Now, right, embedded derivative. An embedded derivative is linking of a host contract, and sorry, is adding a derivative instrument in a host contract. Adding a derivative instrument in a host contract. The base contract is called host contract. Is called host contract, and the extra addition is called derivative instrument. Is called derivative instrument. Embedded derivatives like normal derivatives. Embedded derivatives like normal derivatives will have to will have to go through marking to market. Will have to go through marking to market. MTM part needs to be done. Embedded derivatives also will have to do MTM. Will have to go through marking to market. Okay, we're almost done. Weather derivatives and electricity derivatives. I'll quickly discuss. See, what is derivatives? It gives protection against something going wrong. So weather derivatives will give me protection due to unfavorable changes in weather. Lot of businesses are impacted by weather. Example, an agricultural business may get impacted by weather. An airline company can get impacted by weather. Or let's even take an example of a cricket board. If the weather is going to be bad throughout the year, they also get impacted. So weather derivatives is a financial instrument which is giving protection against the demand risk, not the price risk. Price changes we are not factoring here. We are just focusing on the demand risk. So weather derivatives have emerged as a new class of financial instrument to manage volumetric risk from unfavorable weather pattern, so which influences the trading volume of goods. Hedge the volume risk and not the price risk. Example of users are airline companies. Underlying asset is a weather which can have multiple dimension: rainfall, temperature, humidity, wind speed. Insurance is giving protection against extreme events, extreme low probability weather events such as earthquake, hurricanes, and flood. Derivatives is protection against all types of risk, uncertainty in the normal condition. Weather derivative pricing is very challenging because you do not have data. Past data is there, but the valuation can be slightly challenging because data reliability issues are there. Forecasting is difficult. Temperature modeling changes. So in fact, in our material, we have not solved any question on weather derivative because it is very difficult to do the valuation of a weather derivative, because forecast can be even a challenging thing. Weather derivatives provides protection against volume risk slash demand risk. Protection against volume risk slash demand risk due to due to due to unfavorable changes in weather. Due to unfavorable changes in weather, users can be airline company, farm agricultural produce company, Even an ice cream company can be an user, because if the weather is extreme, the ice cream business can get impacted. Insurance provides protection against insurance provides protection against low probability extreme events. Example is that floods which happened in Chennai, that can be protected through insurance. Weather derivatives provides protection against all types of weather risks. Underlying asset is the weather. Underlying the asset is the weather. Underlying asset is the weather. Weather has multiple dimension: temperature, rainfall, humidity. I think other things are also terrain, wind speed. So this will provide protection against the demand risk and not the price risk. Not the price risk. Be very clear. Valuation of weather derivatives is challenging due to due to data reliability, difficulty in forecasting. This is on the weather derivative side. An expansion of weather derivatives came into electricity derivatives. So your material also talks about electricity derivatives. Now, if you see in the India's context, what happens is electricity power plants, whenever a company is setting up, they'll enter into a power purchase agreement with a lot of buyers. These agreements are normally for a longer period, even 20 years, 25 years. So in this time period, there can be changes in the cost structure, and if the cost structure is changing, you would want to recover higher money from the customer, which may or may not be possible. So you are having a price risk for another 20-25 years. So electricity derivative is more for price risk. India's power purchase and sale involves state-owned distribution company entering PPAs for 20 to 25 years. Volatile electricity price require a hedging instrument to reduce price risk instrument exposure for generators, buyers, and load serving entity. Can help hedging from price risk variation. The purpose is price risk. The purpose is to protect against price risk. That was against demand risk. This is against price risk. Forward, futures, and swaps are the derivative. Electricity derivatives. Electricity derivatives. Power generators. Power generators enter into PPA, power purchase agreement, for longer period. For longer period. Prices can be volatile. Prices can be electricity prices. Electricity prices can be volatile, and protection against the same protection against the same can be can be done through protection against the same can be done through electricity derivatives. Users, power generators, primarily they'll only use, they say individual buyers, if electricity is a very important cost, you may want to enter into, and load serving entities. forms your forward, future, and swaps. Maybe I'm not sure if you can manage space. Just mention primary purposes. Primary purpose is protection against price risk variation. That's the primary purpose of an electricity derivative. Protection against price risk variation. Price risk variation. Okay, what is electricity locational basis swap? See, one issue with electricity is generation of electricity will happen at one place and the delivery will happen at some other place because it is connected through the grid, and in this gap there can be variation in the prices. So electricity locational basis swap, wherein holder of an electricity swap agrees to pay or receive the difference between a contract price and another locational spot price of interest for a fixed constant cash flow at the time of transaction. So I can fix in the price at a geographic location that is different from the delivery point of a futures contract and can be used to hedge the risk for the differences in prices at two different physical locations. So the generation is happening in Chennai, the delivery is happening maybe in Coimbatore or some other place, and if there is a variation in the price, electricity locational basis swap, protection against price risk or price difference between power prices at two different locations. Power prices at two different locations. Power prices at two different locations. One party agrees to or receive pay or receive difference between specified futures price specified futures price and the prevailing at spot price prevailing at specified location. You can say location of interest. I'm interested in that location. Now, last thing, what are the key lessons from derivative mishaps? I don't see any MCQ getting generated from here, but this is excellent thing that derivative is a very, very risky instrument. I would want you to read the entire ICI study material because there are a lot of case studies they have given. Every point, don't buy any derivative product that you don't understand. There is some extra information. There was a case study. If you read that case study, you will get more clarity. I'm just going to write these points. These are the key lessons. But I would want you to read that so that you get clarity on what is exactly being talked about. There's a case study, maybe a two para or a three para, what has happened and what went wrong. So now write key lessons from derivatives mishaps. Derivatives are extremely complex instrument. It can lead to wealth. The entire wealth can get destroyed. Don't buy any derivative product. Don't buy any derivative product that you don't understand. Don't buy any derivative product that you don't understand. Due diligence before making treasury department as profit center. Profit center means it will start making speculation and all. You read that. When you read it, you will get more clarity. Specify the risk limits. Separation of front, middle and back office. There are three offices in a treasury department: front office, middle office and back office. You should ensure that there are interlinkages, but there should be a firewall. Ensure that a hedger does not become a speculator. I've given somebody a role of hedging. He should do hedging rather than taking speculation. Hedger does not become a speculator. Carry out stress test, scenario analysis, etc. Stress test, scenario analysis, etc. I think with this, the derivatives part is over. We have the additional part, the most of things were discussed when we were solving problem, but newer areas like that commodity derivatives was discussed a little bit lengthy. Electricity derivatives there, weather derivatives is there, derivatives mishaps are there. These are additional areas which are there. If there are any doubts, you can message me on this. Thank you, friends.